I think everyone realizes that there are a lot of there's a lot of loans in CMBS or on the CRE debt side of the bank sitting on balance sheets that, given some time, and it's more of a cyclical issue, it's more of a refinance issue. Given some time, we may be able to work out of some of these situations. I mean, the flip side is there's plenty of loans that are never coming back.
Right.
There's plenty of C office buildings that are obsolete, and the keys are coming back, because you have to remember CMBS is a non-recourse market. So if you believe that you have no equity left in your deal and you're never going to have equity, you're not going to keep paying your mortgage. You're going to hand the keys back. It's done. It's over. And the lender owns the property now.
Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show on YouTube at youtube.com/gowercrowd and on good podcasts everywhere. My guest today is Dan McNamara, who is co-founder and chief investment officer at Polpo Capital. I came across Dan reading an article by another one of these real estate reality show guests, Alex Nichol, who is a reporter at Business Insider. And what interested me particularly about the article in which Dan was quoted was that the term "the big short" featured considerably. And I have been wondering how to short the multifamily market, as there is clearly going to be some considerable distress in the coming months. Well, it turns out that, unfortunately, in the way that Michael Burry shorted residential real estate during the global financial crisis, and the way that Dan shorts the market today, isn't yet possible for mere mortals like thee and me. Nevertheless, Dan's story is extremely interesting. He talks about what he's seeing in the office market particularly. He talks about how he shorted the mall industry, or at least part of it, to great success. And he discusses what he's seeing in multifamily real estate in the coming months. The conversation covers CMBS, CMBX, and a bunch of other terms that are usually the domain of financial traders. But you will find it very interesting because it directly relates to what's going on in the markets today and how experts like Dan are investing in the market as it evolves through this crisis. If you'd like to know more about Dan and Polpo Capital, just go to gowercrowd.com and visit the podcast page. And of course, while you're there, do please consider subscribing to the Gower Crowd newsletter. It goes out once a week, and we cover all the top stories in commercial real estate, syndication, and crowdfunding from the past week. It's totally free. And of course, you can always unsubscribe. And one final thing before I introduce Dan to you, I would just like to give a note of appreciation to Ben Applebaum, who is asset manager at Mandelbaum and Associates, who contacted me on LinkedIn with some high praise about the podcast. So I just want to say thank you, Ben, for your kind words. And I hope you enjoy today's episode as well. All right, let's get on with it. Let's meet Dan McNamara, co-founder and chief investment officer at Polpo Capital. Dan, thanks so much for joining me. I'm so pleased to have you. So like I was just saying before we started, the language that you're likely to use during our conversation is it's just going to fly right over the top of my head. So to the extent that you can, start at a nice 101 level, and then we'll dive deep. And please forgive me for all the dumb questions that I'm likely to ask. That's where we'll start. So I read an interesting article, and that's what's prompted me to invite you to join me. And this is what the article was about. This was the headline. It said, "Are office buildings the next big short or the next widowmaker trade? The trader behind the uber successful mall short shares," that's you, shares his playbook, mall short shares his playbook for making money without flaming out. All right. So why don't we start with the MAL? That was not that long ago, right? So what was the MAL short? Why don't we start with that, and then we'll move on to office. And I'm dying to ask you about multifamily as well.
Yeah, no, absolutely. Thanks for having me, Adam. Great. It's great to be here. Yeah, so at my prior hedge fund, Matlin Patterson, we kind of developed a thesis around regional malls and specifically lower quality regional malls. And we wrote a white paper back in 2019. It had been kind of a point of contention. There were a lot of large money managers on one side who believed that the death of the mall was probably a little exaggerated, and there were, a lot of people on the other side of the trade, us being one of them. Carl Icahn famously was part of it. That believed that lower quality kind of BC regional malls, and specifically enclosed malls, were going to struggle and were kind of in a secular decline. So we went out and raised money to do this specific one investment. Traditionally we run a hedge fund that's more balanced, but this was just one specific instrument. It was called CMBX 6. We were short the double Bs, which is the lowest tranche in CMBX. And our belief was that this trade back then in 2019, it was something that was trading at 90 cents on the dollar. We launched the fund in the beginning of 2020, and obviously, something that we thought would take 5 or 6 years to play out, the mother of all catalysts hit in March of 2020. So the investment was very successful, and our investors were very happy with that. But I think the biggest thing that my takeaway was COVID had changed the game in March of 2020, and that's for us. The mall trade was more about e-commerce and how shopping was changed, but the trade was so successful due to COVID and speeding up and expediting this investment process. But it actually led us to our next large investment, which you kind of alluded to, which was the office short.
Right. Okay. So I'm going to ask. So now, okay, prior warning, dumb questions coming. Right. So forgive me for that. Right. So you are investing in CMBX Cs, and you're shorting the BBs. So can you just kind of drill down? What exactly is that? So what is that? Let's just start there. Just explain that.
What CMBX is, it's a derivative based off of, there's multiple indices. There's one every year. It's tranched up from AAA securities all the way down to double B securities, double B rated securities. And CMBX is just a way for us to express short positions in CMBS. So what it is if you've seen The Big Short, they were doing that on the residential mortgage side. They were doing it in an index called ABX, which was subprime mortgages. And today we're doing it in CMBX, which just it references CMBS deals.
Okay, CMBS deals. And you talk about the other side of the trade. And I know that this is important because without having somebody on the other side of the trade, you can't short anything. So can you just explain that concept as though you were explaining it to my 14-year-old?
Yeah, so, quite simply, we're buying insurance on these securitizations, right? And you need someone to write that insurance. So, in the CMBS market, there are a lot of different investor types. There are money managers, there are insurance companies, there are banks, there are hedge funds like ourselves. And, we can't express a bearish view without someone selling us the insurance on the securities. So, a lot of times real money investors, they get money in and they need to invest it quickly. And a lot of these indices are, quicker ways to invest money. So most of the time on the short side, not always, there's a lot of hedge funds who are either hedging their book or expressing this fundamental opinion on these trades. And on the flip side is the people that are writing you insurance that are clipping the coupon. They're more your traditional real money investors, a lot of time money managers. And that's what makes our market. For us, pre-COVID, there were a lot of different opinions on the mall trade and whether we were right or wrong. And it did seem like there were more hedge funds on the short side. But the office trade, it's a little different because, I think everyone sees where office is going right now. So it's not quite as easy to get you someone to write you insurance on a lower quality office building these days.
So what is somebody who's writing insurance? Can you give me some examples of the kinds of people who would do that? this is also a derivative that they're trading, is it? That's basically
Yeah,
what's going.
so it's an institutional market. I always reference the Big Short because they talk about ISDAs. You need to have only institutional investors can invest in this market. There's no way for a retail investor to invest outside of through funds that do it. But it's a derivative, and what you do is Goldman Sachs, Morgan Stanley, Bank of America, all the large banks and the broker dealers, they participate in this market. They will take some positions in it, but post Dodd-Frank and all the regulatory issues with the large banks, a lot of times they're trying to just play more matchmaker in the CMBX market. We need a counterparty, and finding that counterparty sometimes it's easier said than done. But that's what they're good at. So sometimes they'll warehouse a little bit of the risk, but in the end, I think they're more just facilitating the trades. The other side of the trade, I would say the majority of the time are money managers, mutual funds, those large names, and they're doing it for a different reason. They are traditionally long only investors. That's the one thing about the CMBS market in general. I would say 95+% of our market is long only, which for me makes for interesting times, because sometimes you can kind of identify these unique short trades. And because there aren't that many people looking for these things in our market, it can be, very interesting asymmetric opportunities for us on the short side.
Because there are so many people that see long, so they
need longs. It's a long bias market, very much so. Short selling in general, whether regardless of the market, there's not a lot of people out there that are crazy enough to do it because timing's difficult. There's no doubt about it. That's why for us, we try to balance our book. We try to while we're very what I would say is very focused on shorting kind of lower quality office space, there are a lot of trades that are going to benefit from extend and pretend, which I think is going to happen across the board. So we're trying to kind of pair these extend and pretend longs with CMBX shorts. And if you can have a balanced book, or as balanced as you can get, timing becomes less of an issue, because everyone says, listen, the timing can kill you on the short side. On the long side, you're collecting your coupon every month. On the short side, we're paying out our premiums every month.
Right. That's exactly what I was going to ask you again. So I just read The Big Short again recently. It's actually really good book, and a really good refresher on it kind of gives an interesting perspective about actually what's going on in commercial real estate today. But you mentioned you thought that it was going to take 5 years to play out. And I always understood that shorts, and maybe I'm confusing this with options, but when you buy a short position, isn't that a really short period of time that you can, you have a limited period of time and then you have to keep buying? That was the challenge with Michael Burry, wasn't it? That they thought they actually spent a lot of money that looked like it was going down the toilet, and their investors weren't happy with that until they were happy.
Yeah. No.
And so how do you do that with a 5-year plan? I mean, are you underwriting that this isn't going to turn south for 5 years and hedging it that way?
Well, that's the difficult thing. I mean, you are buying CDS, so credit default swaps. That's what's underlying this index. And timing is everything. In the double B land that usually we play in, the most levered part of the capital structure for CMBX, you're paying 500 basis points running, which seems like a lot, but it feels like a lot less in this kind of higher interest rate environment too. So you are paying 5 points a year to have this protection on. In Michael Burry's case, and I think his biggest complaint was he had a lot of single name CDS shorts on, and that's a little different.
What's the single name CDX short?
So it would be you were short one specific subprime deal, and it wouldn't be an index. So the indices, ABX, CMBX, these things are much more liquid. They're traded and marked nightly by Wall Street. The single name CDSs, he basically, in a lot of cases, just reading the book and looking at the movie, there's an infamous scene that, him going to Goldman Sachs and Deutsche Bank and saying, hey, I want to short this subprime security. And I think the big thing for him back then was the people who are marking those securities are the people that you're betting against. So he was so frustrated for the longest time that even though the fundamentals of the housing market were cracking and everybody saw this, and it almost feels kind of like where we are maybe today in the commercial side, is his indices weren't moving. That's a little different with an index. I mean, our index, for example, it's down a decent amount over the last year as fundamentals deteriorate, as more market players are involved. It becomes more of a market than it does, other single name stuff where it's weird if you're betting against someone and they get to decide what the price is every night.
Yeah, that's right. That was the problem, wasn't it? That
it was a big problem for him.
But in that case, it was almost as though, what was it with Burry? It was like they were kidding themselves, or he couldn't understand what was going on. But eventually, they were like, they didn't really understand what they were investing in. Wasn't that the issue there?
I think for the longest time we were in such a bull market, prior to the housing crash, and again, there's a lot of similarities to the commercial side today, but I think they believed that he was paying such a large premium that he would need housing to go down significantly. Obviously a lot of people didn't believe that housing could go down. So the banks and some of the people on the other side of those trades clearly decided to take the other side of the trade. And for him, it was very frustrating. But eventually, as we all know, the fundamentals became overwhelming. And all of a sudden, the same people that were writing protection were very eager to buy that protection back from him. And that's when, the price of this thing collapsed. It's timing. It's difficult. I think a lot of his investors weren't sure how long he could hang on.
I see. So he was buying, and this is what you do as well, Dan. He was buying insurance, and when the market tanked, the price of the insurance went up dramatically, and that's how he made his money. He was then able to sell those insurance policies at a profit.
Yes, exactly. And in his case, a lot of those things went to zero. So he was able to, get basically rip up his insurance. T had massive profits, obviously, because he was very levered into this trade. And I think the majority of his fund was in this trade. That's exactly what it is. You can kind of think of it as an insurance product right now. I'm buying insurance on CMBS securities. He was buying insurance on RMBS securities.
Right. Now, how do you, I'm going to come back to this in a second. How do you raise money? I think I've seen somebody raised 100 million for the current fund. And you mentioned that this is something not accessible to retail investors, but you're not a retail investor. What about your investors? How do you raise your capital?
Yeah, so we're a hedge fund. So basically you need to be what people say is called a qualified purchaser. There's levels that the SEC sets that you can invest in hedge funds and alternative investments. It's all a little different. It depends, there's different fund types, whether it's a hedge fund or, there's plenty of funds that invest directly in commercial real estate, as everyone knows. And there's different levels, for our case, you have to be a qualified purchaser. So yes, individuals can invest in hedge funds without a doubt. But there's different high net worth tests and everything else. Our investor base is mostly family offices, high net worth investors, and fund of funds.
And it's not just plain accredited investors. This has to be qualified investors, all right?
Yes, it has to be qualified purchasers. Yeah,
which is like 5 million of net worth or something. There's a different hurdle.
You got it. I believe that is
something like that, right? Okay, so now you are looking at office. So what's going on in office? If everybody knows that office is going down, how do you buy insurance that makes sense? Is it because you're assuming it's going to drop further than everybody else? Is that the bet you're making?
Yeah, and I think some of it does go back to the majority of the market is long only. So when you can find these opportunities, sometimes they're slightly mispriced. We think that there's a lot of mispricings out there in some of the BB CMBX tranches, especially ones that are exposed to office. It's the one thing to take a step back that's interesting is everyone wants to say, hey, what index has all office? CMBS isn't like that, right? It's a diversified pool. It has multifamily, it has office, it has malls, it has strip centers. Some of these things are going to be completely fine, and some of these things are going to take, massive losses. So it's really about digging in, because in an average index, there's 25 deals in every index, but there's about 50 loans in every deal. So you're talking about a little over 1,200 loans that you have to underwrite. So it's a good thing it's an institutional market, because there's a lot of heavy lifting that goes into the underwriting of these things, whether you're long or short. And for us, the CMBX index has kind of been, especially the double E level, it's been drifting lower. On average, it trades around 60 cents on the dollar. I mean, we think it will be significantly lower at some point. The timing is, who knows, right? If the next shoe drops, it could be in 3 months. And if this thing really bleeds out and it takes a full 5 years, well, we'll pay more premium on that, but that's okay. So, I mean, clearly for us, a shoe dropping sooner than later is great. I would like to pay less premium. And anyone on the short side in CMBX would like to pay less premium. But, it's one of those things from a fundamentals perspective. We know where it's headed. We just don't know how long it's going to take. And if it takes a little bit shorter or a little bit longer, that's going to depend on our return. But either way, we're pretty confident that, there's going to be major losses. These instruments take losses on average about 5%. And historical CMBS losses of 2006, 2007, 2008 vintages were between 10 and 15% on average. So I'm not saying this is going to look exactly like, the GFC. I think it's going to play out a little differently. I think we're going to be probably at the eye of the storm versus the residential market. But to give you an idea of historical losses, when you go through times of distress, they're in the double digits. And in that case, a lot of the double Bs will be wiped out completely. And we'll be able to collect on our insurance premium, whether we hold it to maturity or it reprices itself and like Michael Burry did, and be cashed out.
So when you look at these tranches, so you're looking at CMBS tranches, right? You actually go in and underwrite 1,200 loans, do you? That's your process, and you figure, all right, this overall is underpriced because we think it's deeper underwater than it's currently priced at. That's what you do.
Exactly. It's a very different underwriting process or investing process than the residential side. The residential side is very much quantitative, where you have your models and you have thousands upon thousands of loans.
Price per pound, almost.
Yeah. I mean, for us, you don't even necessarily have an actual address of the house. You've got a zip code, and you're making a lot of assumptions quantitatively about pricing. For us, we know that office building, we know the tenants, we know when their leases roll, we know what they're paying. So you can really get in and dig in. And even though 1,200 loans may sound like a lot for an index, what it comes down to a lot of times is some of the larger loans in each deal. So, that $5 million loan, that's one of the smallest loans in a pool, may not matter as much as that $60 million loan. So it's a different process. It's different than most structured products, where they're kind of shift much more quantitatively, and we get our hands a little dirtier.
Yeah, it's really interesting, actually. When I was at Colony Capital during the global financial crisis, Colony was buying large tranches of non-performing loans from the FDIC, all from failed banks. And some of them had 800 loans in them. I mean, they're just, some multifamilies, there was a lot of single family, a lot of commercial as well. So what is so I was exposed to that kind of large portfolio analysis. So what is actually the process that you undergo? Do you sit down with a spreadsheet and go onto CoStar and Yardi and do the analysis? Kind of explain how you do that.
Yeah, no, absolutely. So for the most part, for us, especially when we're looking at office, it is very much a desktop underwriting. So you're using, CoStar is a huge tool, and that's kind of like the premier tool for commercial real estate investors. It has all sorts of pricing and information in there. We also use TREP and Bloomberg, and TREP is a fantastic. TREP's more for CMBS investors, where CoStar is more for commercial real estate investors, and we're trying to blend those two, and pull as much information out as we can, and really dig and then try to find out what's going on, when a rent roll is, whatever it is. Sometimes quantitatively, when you look at these pools, it doesn't tell you the whole story. But yeah, it's pulling in spreadsheets, it's making assumptions on what you think the valuation is. I mean, the other thing too that we got to keep in mind is sometimes it's not if the debt, if the building or whatever it is worth more than the debt, it's can they pay it off, right? So one of the biggest issues in the CMBS market today, I think, is the maturity wall, right? We've got about 1.5 trillion of CRE debt that's going to mature in the next 2.5, 3 years. And the regional banks are not lending. The CMBS market is down about 75% from where it was last year. And last year was not a good year. So you have this wall of maturity hitting, and you have a lot of loans that are coming up that maybe they were issued at 50, 60 LTV. Well, they're coming due in the next year or two where there's this massive need. There's equity left in that deal. Maybe the LTV is 80, maybe it's 90, and they can't refi. So what are we gonna have here? And my belief is, in the CMBS market specifically, but I think you'll see it with the banking system, if you have equity left and you're committed to that property, you're going to get extensions, you're going to get forbearances. That's why I think, I think you heard me in another interview say this is going to take 5 years. I mean, there's going to be buildings that are going to default before maturity, but I think there are going to be a lot more buildings that are going to get extensions, and then we're going to figure out later on, years down the road, whether they redefault.
Yes, exactly.
Hopefully by then the financing market will be in a little better place.
Interesting. So now, so your analysis of these CMBS, you are relying on somebody on the other side, the counterparty, not to have done the same degree of research, or at least to have done the same but not see the world in the same way. Is that kind of, again, the bet that you're placing?
Yeah, I think it's some of that. It's some of, a lot of long only investors that need the coupon that I'm willing to pay them. They have to have obviously a view that it's worth more than I think it's worth. Otherwise they probably wouldn't think the coupon's worth it. But yeah, it's a lot of things. There's plenty of inefficiencies in our market. It's a very nichey, unique part of the market. The CMBS side of the market, it's only about 15% of the total CRE lending market. And not everyone does it, right? Like I said, it's an institutional market. You can't call up your broker at Fidelity and say, I want to short CMBX, or even I want to buy CMBS.
Right.
For example, there's no CMBS credit ETF to buy options on, against, or to go long. There's one ETF out there. It's actually called CMBS, but it has a bunch of AAA CMBS and government-backed securities. So what you're betting on there is all those bonds will be paid. You're just trying to figure out, will they be paid on time? So it's a very different world than what we're doing.
Right.
We're investing in long and short securities that have real credit risk, that aren't AAA, that aren't government backed.
Right, which gets me back to the same question I asked before. So retail investors, accredited investors, can't invest with you. It's just simply not allowed, is it? You cannot bring that kind of capital into your fund.
Right. Yes, you have to be in our space. You have to be a qualified purchaser. There are other funds that accept accredited investors, and then there are more CRE focused funds that I think they take another level down. There's definitely private REITs that I don't think you have to be accredited for. I don't want to speak. We don't do that, but right. Yeah. So it's just it depends on how many investors you have. I think how big you are. But yeah, it's either accredited or qualified on the alternative.
Not accredited for you anyway. It's qualified, not accredited.
It's qualified.
So okay. So the whole world thinks that office. The whole world thinks that office is tanking. So how can you make money on that? And where do you think it's headed? If everybody thinks that way, are there really that many long players in office?
Well, it's funny you ask that question. The open interest, which is basically in any derivative, right? It's just how many outstanding contracts there are. If I take the open interest of what I would deem these 3 or 4 BB CMBX instruments that have exposure to office that we think are going a lot lower, we're talking about less than $1 billion. The open interest on CMBX 6, which was the big short that Carl Icahn got a lot of publicity for, that between the single A's, triple B minuses, and the double B's had over 12 billion of open interest at one point. So what does that tell you? What does it tell me, at least as a CMBS investor? There were a lot of people that were willing to take the other side of the mall trade than there are willing to take the other side of the office trade. Now, it also trades at a lot different price, 90 cents versus 60 cents. So there's a lot of nuances. that the idea is, though, that it's very difficult to play in CMBS credit. Is while it's an institutional market, it's very difficult to play in the pockets that we play in if you're too big. And I think the very, very large private equity firms, large macro hedge funds, if they see a derivative that has less than $1 billion of open interest, they don't want to play.
Why is that?
There's not enough liquidity for them. So it's just one of those things. I touched on the idea that it's a niche market. It's a niche market, and it's really in certain pockets of it, being smaller and nimble, and maybe not having the largest fund in the world. These multi-billion-dollar funds, they want to write 100, 200, $3 million checks. Right. We may spend all day on a $3 or $4 million investment. Which I think kind of makes us a little different and makes what we're investing in more interesting.
How often do you actually trade then? If there are only three, I think you said 3 or 4 CMBXs, you must identify those that you got a target on, decide, okay, this is the one we're going after. Here's our premium. And then what's left for you to do other than just keep paying the premium each year and tracking what's going on with those tranches?
Well, I think where we spend a significant amount of time on is our long side of our book. We talk about extend and pretend. We talk about the lack of refinanceability of a lot of these loans. Our favorite trade right now that we pair with our CMBX shorts is interest-only securities. And basically, all these are the excess interest of a CMBS deal. And so the reason why they do very well, it's not a bond you're going to get principal back one day. It is just excess interest after you pay the bonds, the excess interest in a deal. So the reason why we love it in a world where all these loans are going to extend is, you can buy an interest-only cash flow stream that might be maturing in 2 years on paper. But when you do the underwriting, you realize there's no way some of these loans can pay off in 2 years. So what happens? The special servicer extends them and we collect more interest. So that to me is this like really unique, weird long that you can find in a niche market that actually benefits from distress. So, just think a building owner comes up and we think it's an 80 LTV loan. That guy wants to hold on to his building, right? He's going to go to the special servicer. The special servicer is going to say, okay, we'll give you a 2-year extension. Just keep paying your mortgage. Well, that extra interest on his mortgage is coming to the interest-only security. So that, to us, is a really, really fascinating trade today as we wait for the next shoe to drop. Now, my background is buying deeply distressed securities, buying controlling pieces of CMBS securities. But until that next shoe drops, until those prices really get down to the 40, 30, 20 cents on the dollar, we need to do some interesting stuff on the long side. And that's where we spend all of our time, because you're right. There's only...
Oh, I lost you. Hold on. Wait, you've gone silent. I lost you.
Oh, no.
Okay, there you go. So what was the last sentence you said there?
There's really only a handful of CMBX securities that we want to be short. So we spend a lot more time on the long side, and we have to be very careful, because if you look at on the run CMBS cash bonds, triple B minus bonds, they were down about 40% last year. So if you buy the wrong thing in the CMBS market, you can get really burned. So we're very careful about our credit underwriting and where we play.
Really interesting. So, and I type notes so that I can stay ahead of you just a little bit. I'm trying to anyway. So the big difference with the GFC and today is that during the GFC, banks were essentially mandated by regulators to mark to market their entire portfolios, and that just created this huge what would you call it, vortex, if you like, that everything kind of dropped into. And banks then had to clean their balance sheet by selling either the loans or putting, taking assets back and selling them, etc. This time it's different. This time regulators have been telling banks, encouraging banks to work with borrowers to extend. Now it's different, I presume, on the CMBS side. But is there more extension? Is there more accommodation of borrowers today than there was during the global financial crisis in CMBS?
Without a doubt. I think everyone realizes that there are a lot of there's a lot of loans in CMBS or on the CRE debt side of the bank sitting on balance sheets that, given some time, and it's more of a cyclical issue, it's more of a refinance issue. Given some time, we may be able to work out of some of these situations. I mean, the flip side is there's plenty of loans that are never coming back.
Right.
There's plenty of C office buildings that are obsolete, and the keys are coming back, because you have to remember CMBS is a non-recourse market. So if you believe that you have no equity left in your deal and you're never going to have equity, you're not going to keep paying your mortgage. You're going to hand the keys back. It's done. It's over, and the lender owns the property now. But you're right. On the CRE debt side and the CMBS side, your people want you to extend. People, if someone wants to hold on to the property, they want them to hold on to the property, because in that market, your best borrower is your current borrower, right? So you don't want XYZ hedge fund, private equity firm coming in and buying it and at a distressed level, and it might not be good for you as the lender. So for us, I think, the way we look at the world is we're going to live in this kind of, I say extend and pretend. It is extend and pretend in some markets, but some of these extensions are really good things. And if we can avoid, losses that don't need to be taken 2 years down the road, that's great. I just hope that, people fess up a little bit to some of the losses that will inevitably come anyways.
Well, the term extend and pretend was coined because there was this general belief during the global financial crisis that we were never going to get out of it, right? So that was the idea. It's like you're extending and pretending, you're just extending to the inevitable. This time, again, is different. I hate to say that, but this time is different, isn't it? Because at least in terms of the market's perspective of what's happening, that there is this sense that this fight against inflation, these higher interest rates, which is causing all this distress, is going to be won. The battle will be won, and interest rates will come down. So there is this sense that there's light at the end of the tunnel. Do you harbor that same perspective?
I think there's light at the end of the tunnel for some assets. I don't believe, I've been talking to a lot of commercial real estate investors, over the last year. And it's always like, well, when rates come down, and, I have to pause and say, historically, rates are not that high. We've all been living in this, zero rate environment for a very long time. And, you get used to that. But, 5% 10-year note, it's historically not that high. You can go back to the 70s and 80s and look at interest rates, and they're a lot higher. Now, I don't think we're going back there. I don't think anybody wants that. So there's going to be some pain. There's going to be losses inevitably. If you look at the floating rate side of our market, that's a mess, right? You've got people that were taking out, 3% floating rate mortgages that are at 8 or 9 now, and they can't pay it anymore. And there's really no solution for that besides.
Oh, I lost you again. I don't know why you keep going on mute. That's really weird.
Oh, that's weird.
It keeps jumping out. Okay. Yeah. So that actually does bring me to, to this. So the point you're making, and I hope it was recorded on your side.
I hope so, because if you sometimes it freezes on my side, if like something happened and I'm not hearing anything. I think it might've recorded. We'll see.
Yeah, we'll find out later. Right. But so you were talking. Yes. So there's a lot of these 3% mortgages on floating rate that are just, the price has to reset, and when pricing resets, those are going to be underwater. They will transfer to other owners. It's just impossible for those to be salvaged. Which brings me, of course, and I keep saying every to what multifamily. Yes. So here you are sitting there in an office. I think I'm not sure if you are, but I know you have been actually in an office. I think that one of the quotes is looking down on the biggest office market in the world in Manhattan, right? But you also probably live in a residence somewhere.
I am actually coming to you from my home today. We are hybrid, and our entire company's hybrid. We're in Midtown Manhattan half the time, and we're coming to you from Westchester half the time.
Dan, you absolutely have to do that. I remember my father many 100 years ago was doing business with I don't know, British Leyland or something. He used to drive a Ford car. And he said they were furious when he showed up in a Ford. they were not happy. So you have to work out of home some of the time. If you
can't be in the office 5 days a week, it would go against our entire investment thesis.
It's like no one would invest with you. It's like, hey, you got to have confidence, right? All right. So what about multifamily? I mean, this has been my focus is just recently, everyone was talking about multifamily is impregnable. Everybody needs somewhere to live and blah, blah, and etc. Right. But the world has changed. And the last 2 years have seen massive lending at these low rates, short-term maturities, short-term rate caps. This multifamily market is coming home to roost, all of that stuff. What's your view on that? And are you planning on looking, and actually, is there an opportunity for you in CMBX for multifamily that you're starting to look at?
Multi in general, we're not as bearish on multi as we are in certain office space, but there's going to be massive issues. There's no doubt about it. The CMBX shorts that we do are fixed rate CMBS deals. There's no floating rate deals. And I think a lot of the issue with multi, there's a supply issue. Everyone knows there's a significant amount of supply coming online in the next 12 to 18 months in multi, which will pressure rents. But the other side of it is where I think, there's not going to be any answers except for some losses is a significant amount of multi got done in CRE CLOs, which were floating rate CMBS, commercial mortgages. And these are the loans we're talking about that were done at, let's call it 3%, 4%, and they reset to 8 or 9%. And, cap rates, there haven't been a lot of transaction volumes, but you can't tell me that the cap rate is 4 or 5% when the 10-year note's at 5. I just don't believe it unless, you're the greatest interest rate trader of all time and, interest rates are going to 0 and nobody else knows that. So, for us,
right.
You look at supply on the the fundamental side, there's supply coming onto the market that's going to pressure rents. But you also, you have a mismatch of a lot of your liabilities on the floating rate CMBS side. And so many of those things got put into CRE CLOs, which it's another fancy name for higher levered loans. They were transitional, right? So they had a higher leverage. That's just the definition. And they were floating rate.
And short term.
It's higher leverage, short term, now much higher interest rate. And it's a recipe for disaster. There's no way to take advantage of that specific market on the short side, unfortunately, because there's no CMBX instrument off of that. But, I think it's going to provide opportunities on the long side coming down the road because we're going to have a reset, right? We're going to have a massive repricing on assets. So it's something to watch. I think it's not been talked about as much, but it's definitely going to be a really interesting part in certain pockets of distress.
Oh, it's going to be massive. Multifamily. I was talking to a loan broker, that's from an earlier podcast, James Eng at Polpo Capital in Texas, who has lent just his one shop. He's a mortgage broker. For the last 2 years, or from 21 through the end of 22, he said they wrote over $2 billion, 90% of loans, 90% of which he said is underwater now, worth less than the debt that they put on. 90%. This was all bridge lending that went into CLOs. So actually, the real reason that I was calling you was because I was wondering, I think, unfortunately, you've already answered the question, but there really is no way of shorting that. And if you think, I'm extremely bearish about these CLOs. I think that there's all kinds of, and I don't really understand this market particularly well. I'm just getting to learn it. But the idea is that the CLOs stay on the lender's books somehow, and they can swap them out. But if something goes bad, they can swap it out. But if the entire book goes bad, which some of these could well do, is there no way of shorting that kind of situation?
Well, you got to remember, so this is shadow banking at its best, right? So these finance companies, some of them are very large. Some of them people have never heard of and are very large. They all have different types of what I would say backing and pocketbooks. And I think there are going to be some that were slightly more aggressive and are going to have issues, but, hopefully they can plug some of those holes and be able to swap out. But you're right. If it builds up and it gets as bad as it, might get, at some point, these securitizations are going to have a massive issue. And so what happens is they make all these transitional loans, higher LTVs. Traditionally, they're 3-year loans with floating rate loans with 2 years of extension options. The borrower has to buy an interest rate cap, usually for the first 3 years. to get his extension, he's going to buy a new interest rate cap.
Right.
That's an issue because, you know, the cost of that is just exploded, as you can imagine, given the rate volatility and just the higher interest rates. So, and then what they do is they securitize them. They have a bank securitize them and sell them to investors. They tranche them just like the private label CMBS market, triple A's. Usually it's triple A's down to triple B minuses, and then they retain everything that's non-investment grade. That's their risk retention piece. They hold it. So when they're going to get hit, you know, some of these securitizations are going to get hit with a bit of a double whammy, right? You're going to take losses on the bonds you're retaining, and then you're going to try to be buying some of these loans out to protect basically your business, because you don't have a business anymore if your securitizations go to, you know,
collapses,
take massive losses. So it's an area to watch. It's an even smaller portion of our market, and it grew in the last few years, but so it's even nichier in a niche market. It's unique, but there's no derivative off of it. So in reality, there's no obvious way to short these securitizations. We don't have single name CDS anymore. But you know, we'll see. I shouldn't say I look forward to the losses, but I think I look forward to the opportunity that some of the repricings will take. You know, there's going to be securities for sale that are going to be at massive discounts that will pay off at par, and there's going to be plenty of losses down the capital stack. That's just that's the cycle we're in right now.
Dan, what a pleasure talking to you. I've just noticed time. It's one of those things that suddenly time flies, you know, when you're having fun. I'm really enjoying talking to you and learning from you. Thank you so much. Let me kind of wrap up. I'm going to ask you something really unfair now. But I suppose this is what all of your investors want to know as well. So as we wrap up, I'm going to date stamp this call. Middle of October 2023, interest rates climbing. What was it? What was it? 10-year treasuries hit what? 5%? It's like 5%.
5% yesterday.
For the first time since when? Since like 2020? I mean, a really long time ago. So interest rates still climbing. It looks like they're still going to climb. Really crazy geopolitical stuff going on in the world at the moment as well. Looking to the future, into 2024 and into 2025, predictions, please. This is the unfair question. Where do you think we're headed, and you know, what's going to happen in commercial real estate in the next 12 to 18 months?
Yeah, I mean, just looking at Fed policy and what's happened, right? It traditionally takes 12 to 24 months for a tightening to really hit the economy and in commercial real estate. So I do think, you know, we're past the point where something's going to break. You know, the stress that we're seeing underneath the hood in the CRE market, it's there. Not everybody wants to realize it. Obviously, everyone's hoping that, you know, there's going to be something, you know, hope's not a strategy, right? So do I think that interest rates 1 year forward will be lower? I do, actually. I don't think there's going to be any sort of, you know, massive cutting from the Fed anytime soon. But I do think we're very close to something breaking. And for that, I just don't see them continuing to raise interest rates. So you could imagine if something does break, even if they don't cut immediately, there will be a flight to quality. And, you know, we're going to have some sort of repricing and kind of the risk-free rate. I don't, though, as I said earlier, think we're going back to some world where, you know, the 10-year note's at 2%. So, you know, I would say that, you know, we're here for a little bit, but I do think that what's been done in the past is going to catch up with us, specifically in commercial real estate. And you could see that risk-free rate lower in a year from now.
Breaking something, but I did say last question. I always lie when I say last question. I've got two last questions. Right. Here's my last question before my last question. Something breaking. What does that mean? Like a major bank collapsing, or who knows? Like what kind of, what do you mean breaking?
I mean, I think without a doubt, you're going to see major regional bank consolidation. I think you're probably going to see some more failures. I think that's inevitable. You know, I think that we figured out probably a better way to handle those things. You know, we came out of March fantastically well, all things considered. If you told me a year ago that we were going to have regional banks collapsing and we would be where we are in the macro markets, I'd be surprised. But I do think things are going to break. It takes time to filter through. There's a lot of people hanging on by a thread, especially in commercial real estate. And, I could see rates being a little bit lower, and hopefully that will save some people that are on the edge. But losses are coming without a doubt.
Oh, that was me. Good grief. Sorry about that. What an annoying thing there. Right. So last question before I say thank you. Polpo, Polpo. Your logo is an octopus.
It's right here.
Okay, there you see. Flash bears his chest in a manly fashion. But so what is Octopus? Where does it come from? Why Polpo? Just explain that briefly. Name of your company, Polpo Capital. Polpo Capital.
Yeah, Polpo Capital. Yeah, so it's Octopus in Italian. The way it's spelled, it's also octopus in Spanish. But my son named the company. His favorite sea creature is our octopus, and he loves them. And so it's very difficult to find a name when you're looking for a hedge fund name, because there's been thousands that have started, stopped, are still here. So my wife and I, every year, I'm half Italian, my wife's Italian, she still has family back there. So before we had kids, we have 2 little boys today, but before we had kids, our annual trip was to Italy. So Italy has a place in our heart. And, the fact that this was his favorite animal, we said, well, this just makes too much sense. And we hope people can say it because it's on most Italian restaurant menus. So
forget it. This is America.
That's
you know what I'm going to make a rude joke about Americans, but you know what they call somebody who speaks 3 languages? Trilingual, right? Somebody that speaks 2 languages? Bilingual. Yeah. And somebody that speaks 1 language? American. I'm glad this is at the end, so hopefully not too many people make it all the way. Otherwise, I'm going to get some.
That's pretty good. I like that.
So you assume that people know how to spell it or what it is. I'm not so sure. However, I do recommend anybody listening that they should connect with you, if you don't mind me making such a recommendation.
No, I'm always happy to connect.
Your feed actually, it is on Twitter, isn't it? It's
on Twitter.
Yeah, the Twitter feed. So Dan McNamara on Twitter. What is your handle actually on Twitter? What is it?
Dan J McNamara.
Okay, Dan J.
My middle initials J.
You can find it really easily because the logo is an octopus. And you put out a lot of good content, and it really feeds this message. I love following it. So thank you for that. And Dan, co-founder, Dan McNamara, co-founder, chief investment officer at Polpo Capital. Thank you.
Thanks so much for having me.
All right, that was Dan McNamara, co-founder and chief investment officer at Polpo Capital. Thank you so much for joining me, Dan. It was a real pleasure talking to you, and I do look forward to chatting with you a little bit more to see whether or not there is in fact a way of including accredited investors, not just qualified investors, to your offerings. It would be interesting to explore that. Whether or not it comes to anything, it was a real pleasure meeting you today, and I really appreciate you taking out the time today from your busy schedule. And of course, thank you too, dear viewers, for joining us today. It was a very interesting discussion. If you have not yet subscribed to the Gower Crowd newsletter, please go ahead and do that. Just go to gowercrowd.com and hit the subscribe button. There is actually a list of all of our subscribers, not all of them actually, a subset of the companies where our subscribers work. It is a very interesting list. Go ahead and take a look at that. Just click on the subscribe button at gowercrowd.com. And if you like what you see, subscribe to the newsletter. It's totally free. It goes out once a week, and you will get detailed updates on what's going on in commercial real estate syndication and in the industry overall. And you can always unsubscribe. Right, that's it. Thank you so much again for having joined me. And until next time, this is Adam Gower signing off.